In today's lesson, we're going to have a look at revenue, and this is the last thing that we need to know before the next chapter. So, revenue, what is revenue? It's the income received from the sale of a product. And it's important that you guys don't confuse the word revenue with the word cash. It's not the same. I can be selling my products for cash, but I can also be selling my products and offer my customers credit, or maybe I can sell and offer my customers to pay in monthly installments. So the fact that I make the sale does not mean that I receive the cash at the same time. I might receive the cash later. However, in my accounts, I'll see the revenue coming in that at that particular moment when I make the sale. So the revenue will be recorded on the firm's accounts, whether the cash has been received or not. Also, revenue is not the same as profit. Revenue is calculated as price times quantity. So basically, once you make the sale of the units, that you take the units times the price for what you have sold it for. But actually, how do we calculate profit? Profit is taking into account also the cost. So yes, the total revenue, this is something I have sold my products for, but I also need to deduct the total cost, and that's how I will get profit. This is super important. You guys will need to know this equation by heart. Profit equals total revenue minus total costs. In a way, because of this equation that total revenue equals quantity times price, we can say that price is revenue earned from one product. And the last definition is revenue stream. So we can be, as an organization, we can be doing different activities, we can be selling different products, and the income that we receive from the sale of a particular product is one revenue stream. We can be selling multiple products and then therefore have multiple revenue streams. And there are both benefits and drawbacks to that, but we're going to discuss that in a few minutes. So the total revenue is calculated as price times quantity sold. And when we're drawing the total revenue line on the graph, we have the output in units on the x-axis, revenues and the currency on the y-axis. And the total revenue line is going to be a straight line and increasing. It's going to be starting at 0 and increasing. Here we're not counting with any, let's say, discounts that we would give to customers who are buying large quantities of our products. We're assuming that the total revenue is a straight line. And now to revenue streams. So as you can see, this business has different factories. Let's say that each factory is selling a different product, producing a different product. And based on that, it has different revenue streams coming from different activities. There's a benefit of having more trading activities, and that's the diversification of risk. If I have more products, I'm diversifying my portfolio. If I'm producing even in more industries, I'm also even better at diversifying my portfolio as a business. Another benefit is that it should lead to higher total revenues. That's logical. Each product is going to have a different demand. There's going to be different seasonality of how the product is being sold. So these, let's say, products, these revenue streams, they might be complementing each other. And the more you have, the higher total revenue you are likely to get. However, everything has its drawbacks. So so once you have more revenue streams, obviously you're going to need to invest more time, more effort into managing and controlling each activity. And the fact that each activity needs to be managed and controlled can lead to the business losing focus. Okay, losing focus, meaning maybe it's less likely to succeed in the original business activity, less likely to, let's say, head in the direction of its mission and vision, and might get lost, as in the direction of the company might get lost. Another drawback is that in order to monitor success, you need to separate the accounts. So I need to be looking at the accounts of one project, one revenue stream separately, another revenue stream also separately, to see whether the projects, whether the different revenue streams are successful, whether the products are worth investing our time in, money and time. And if not, then maybe as a business you would get rid of one of those revenue streams, one of those projects, if they're not worthwhile. And now an example of a business that has multiple revenue streams is Apple and its products. So this was an example from the book. Also with many products that you probably know: Mac, iPhone, iPad, service, Apple TV. They're selling software or applications in their app store, iTunes content. These are all different revenue streams for Apple. And that's how they increase their revenue, by offering all these different products and services. And basically, this is the end of the chapter. We've covered the different types of costs. Now we know a little about total revenue and how it's drawn, and what are the sources of revenue. So what are different revenue streams? Now we're completely ready to move on to the next chapter.